Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Imagine a world where machines don't just follow commands. They think, they sense, and they protect. Where artificial intelligence quietly stands guard in schools, stadiums, and airports. And radar so advanced it can detect a cyclist behind a truck or a drone in thick fog. That world isn't science fiction anymore. It's being built right now by a new generation of innovators. Small, ambitious tech companies combining AI, robotics, and real-world intelligence to make daily life safer and smarter. In today's analysis, we're looking into two under-the-radar stocks operating at the intersection of security technology and autonomous sensing. Companies pushing boundaries that could reshape how we experience safety, mobility, and automation in the years ahead. We'll explore their business models, growth numbers, financial health, and the risks investors need to understand before jumping in. One of these companies is using artificial intelligence to transform public security. The other is reinventing how machines see the world. Both are small now, but they're tackling billion-dollar problems. Full transparency, this is analysis and commentary. The information shared in this video is for educational and informational purposes only. All data and insights discussed here were sourced from publicly available information, including the company's official websites, press releases, and investor reports, as well as reliable financial sources. Not a buy recommendation. Always do your own research before making investment decisions. Before we dive in, please take a second to hit the like button, share it with your friends, and subscribe. Please help this video get at least 500 likes. It really helps support the channel and keeps us bringing you the latest market insight. Thank you. First up is Canaan Inc., ticker CAN. Established in 2013, it's a technology company focused on ASIC high-performance computing chip design, chip R&D, computing equipment production, and software services. In plain language, they design bespoke chips, ASICs, that do one job extremely efficiently, and they package these into mining machines under their Avalon brand. That's historically significant. The founding team shipped the world's first batch of mining machines using ASIC technology under the Avalon brand back in 2013. So, they're not new to this game. They helped invent a critical piece of the Bitcoin mining hardware timeline. Industrially, they sit at the intersection of semiconductor design and data center-style computing equipment. But their product market historically centers on cryptocurrency mining. That gives Canaan exposure to chip design cycles, equipment manufacturing, and the economics of Bitcoin and mining power. So, is Canaan a chip designer with a hardware distribution muscle? Or is it primarily a mining revenue play exposed to Bitcoin's price swings? The answer is both, and the financials. We'll reveal how those two sides are performing. Canaan announced strategic investment from Brevan Howard, Galaxy Digital, and Weiss Asset Management. They announced a registered direct offering of American Depository shares for $72 million. Fresh funding like that is a major liquidity event and can provide runway for R&D, production scaling, or working capital. Canaan unveiled a next-gen Avalon A16 series Bitcoin mining machine with a breakthrough ASIC chip, suggesting product performance improvement. They also launched a gas-to-computing pilot in Canada and secured a landmark US order. Amid mining recovery, a partnership in Texas deployed 20 megawatts of next-gen miners at a wind-power data center. Each move signals diversification, product improvement, and better energy partnerships, critical for mining margins. But do the headlines translate into better profitability? Let's look at the numbers. Total revenue in 2025 Q2 was $100.2 million, up from $80.8 million in Q1 and $71.9 million a year earlier. Mining revenue was $28.1 million, up from $24.3 million in Q1 and $9.3 million a year earlier, a major jump due to higher Bitcoin and more energized mining. Power. Cost of revenues was $90.9 million. Mining costs rose sharply due to more machines operating, increasing depreciation and electricity costs. Gross profit in Q2 was $9.3 million, a big improvement from the small profit in Q1 and a loss last year. This turnaround came from higher sales and fewer inventory write-downs. Operating expenses were $36.4 million. R&D was $16.4 million. And sales, marketing increased to $4.5 million. R&D is high but typical for a tech company pushing new generations of ASIC chips. Net loss was $11.1 million, drastically improved from an $86.4 million loss in Q1. Non-GAAP adjusted EBITDA was a positive $25.3 million, showing stronger operational cash flow. Basic diluted loss per ADS dropped to 0.03, indicating narrowing losses. Revenue growth came from increased computing power sold, higher selling prices, higher mining revenue due to Bitcoin price, lower write-downs risks, mining economics tied to Bitcoin rising, depreciation, need for continuous capital, exposure to hardware cycles. If Canaan continues improving power efficiency and securing cheap energy, margins could improve significantly. Now, Stereotaxis, ticker STXS. Stereotaxis is a global leader in robotic technologies for treating cardiac arrhythmias. Their robotic magnetic navigation platform improves catheter precision, reach, and stability during heart procedures. Over 100,000 patients have been treated with their technology across 100 hospitals. Their business model is hybrid, system sales plus recurring, consumables, catheters plus service. They announced EU launch plans, partnerships for pulsed field ablation, NVIDIA Connect program acceptance, and new first-in-human results for their Magic catheter and Genesis X robotic system. These clinical milestones are crucial because adoption drives long-term recurring revenue. Q2 2025 revenue was $8.8 million, up 95% YoY and 18% sequentially. Recurring revenue was $5.8 million, up 35%, driven by catheters and Magic's initial launch. Gross margin was 52%. Recurring margin was 68%. System margin was 22%. The high margin in disposables is key. Growing the installed base boosts recurring revenue and future profitability. Operating loss was $4 million. Adjusted loss improved to $1 million. Cash was $7 million, later boosted to $18.8 million through a $12.5 million raise, with no debt. Cash is crucial for medtech regulatory pathways. Risks: regulatory approvals required, negative free cash flow, low system margin, need to expand installed base. Stereotaxis is a clinical robotics growth story. High risk, high reward, with improving financials and strong recurring revenue. Comparing the two, Canaan, $100.2 million revenue, cyclical, tied to Bitcoin, improving EBITDA. Large capital raises, Stereotaxis, $8.8 million revenue, smaller but high-margin recurring model. Regulated medtech, clinical catalysts, which is safer, depends on preference. Commodity plus hardware cycle, Canaan. Clinical adoption plus medical robotics, Stereotaxis. If this analysis helped clarify the differences between these two robotic plays, hit like, share with someone who likes detailed stock analysis, and subscribe for the next breakdown. Thanks for watching. See you in the next breakdown.